in fact, the treasurer is solely then focused on exception management as opposed to demonstrating day-to-day adherence to the policy.
Welcome back to the Bankers Masterclass series in association with Deutsche Bank and dealing with rethinking liquidity and investment. I'm Brian Caplen, editor of The Banker, and my guest is Vanessa Manning, who is Global Head of Investment and Liquidity for Deutsche Bank Transaction Banking. And in this final chapter, we're considering the whole negative yield environment and the investment strategies for dealing with that. I mean, negative yield has been a real problem, hasn't it, for both banks and corporates for some time. So what can we offer people in order to help them out with that?
Let me take a little step back prior to the negative yield. I think for most large corporates and institutional customers, for the last 7-8 years, there's been a very intensive dialogue between a bank and its customer around the value of operational balances and how the banks have categorised those and agreed those with their regulators and supervisors.
All right, and this relates back to Basel III, is that right?
Absolutely, absolutely. So this dialogue with customers has ensured that our institutional corporate customers are very well aware of the value of operating balances to a corporate and institutional organisation, as defined by the regulation, and therefore they understand the importance of having a range of on-balance sheet solutions which the bank values.
So they've got to hold this money, but then it's a question of using it effectively while it's being held. Absolutely.
So negative yield that has prevailed across Europe and some of the other currencies in Europe and in Asian markets has meant that our customers have been asking us for a range of alternative solutions, whether those are paired time deposits, whether those are kind of very simple FX swaps that can be done to convert from negative yielding currencies into positive currencies like US dollars, for example, and return the balance overnight. So there's a range of solutions that we have worked with our customers on, which straddle, if you like, alternative currency, foreign exchange swaps, and basically cross-border interest optimization solutions, where customers put together positive and negative yielding currencies and withdraw and optimize their position based on, for example, a dollar.
So is there a sort of a rationale as to why you would pick one of these strategies over another?
No, I think it's very individual, based on a customer's individual investment policy parameters, which are under review by most of our corporate and institutional customers this year in light of money market fund regulation reform in the US and Europe, which is going to happen next year. So what we're seeing in terms of client dialogue, not just overcoming negative yield and the variety of foreign exchange and...
Although that is a big problem in itself.
That is a big problem in itself. But what we are seeing is a request from our customers to help them rethink their investment policy and how that should look like. We are seeing a request from customers how we can support them in automating and adherence to those investment policies. For example, we are working with a number of customers here in Europe to develop a solution where we implement automatically their investment policy parameters, embed them at Deutsche Bank, and therefore, for example, when a customer says, I expect 30% of my available cash to be left on operating balance, I expect the next 30% to be invested in daily liquidity funds at this benchmark, and I accept the surplus to go to a third-party money fund such as XYZ, that the bank is able to automate the execution of those instructions, that we can provide back immediate visibility, dashboard and compliance reporting, and that in fact the treasurer is solely then focused on exception management as opposed to demonstrating day-to-day adherence to the policy.
All right, so this is all good stuff. Even if we get out of a negative yield environment, this is very positive for how you manage your cash and your flows.
Absolutely, and that's something that treasurers in part do today using APIs, and this again is one of the benefits of PSD2, is forcing the banks to be API ready, not just for communication and payment and account balance information, but really thinking about how we can use APIs to transform how liquidity management works.
Okay, Vanessa, thank you very much for helping us
Thank you.
rethink liquidity. Thank you.